Have you felt that sudden chill in global markets recently? I mean, if you've been tracking financial news, you know the old saying, when Tokyo sneezes, the rest of the world's markets scramble for a tissue. Lately, we've seen immense pressure on the Japanese yen, massive interventions by the Bank of Japan, and, well, whispers of a secretive bailout from Washington. But in a world full of sensational, clickbait headlines, what are the actual macroeconomic facts here? Today, the goal of this explainer is to just cut right through all that noise. We're going to demystify Japan's really complex currency situation by looking strictly at the hard data. Is Japan heading for a financial crisis? It's literally the question plastered across financial blogs and cable news tickers right now. With the yen under historic pressure and bond yields creeping up, the word crisis gets thrown around a lot. But are we actually looking at a sovereign default in the world's third largest economy? Or is this just standard central bank plumbing functioning exactly as it's designed to? Okay, let's dive into this by peeling back the onion on these global macroeconomic forces, step by step. So here's our roadmap for today's explainer. First, the falling yen. Second, Japan's economic dilemma. Third, the carry trade danger. Fourth, debunking the bailout myth. And finally, we'll look at 3 future scenarios. Section 1. The falling yen, and a closer look at currency depreciation. Back in late July 2026, the yen hit a critical pressure point, briefly plummeting to a staggering 164 yen per US dollar. That was its weakest level since 1986. Think about that for a second. Now, even though it settled near 159 by August following massive intervention, a move of roughly 8% in a single year for a major G7 currency is just incredibly unusual. Japan is not some volatile emerging market. It's a cornerstone of the global economy. So a swing this dramatic, it creates massive waves. To really grasp why this matters, we have to look past the trading floors and see how it hits the real economy. Imagine a Japanese oil importer. They buy oil priced in US dollars, let's say $100 a barrel. When the exchange rate shifts from 140 to 160 yen per dollar, their local cost suddenly jumps from 14,000 to 16,000 yen, right? That is a 14% price hike based purely on the currency losing value. And because Japan relies heavily on imported energy and food, this abstract macroeconomic data directly smacks everyday households through surging fuel and supermarket costs. Moving on to Section 2. Japan's economic dilemma and the Bank of Japan's incredibly tough position. The core issue really comes down to the stark yield gap. Even after the Bank of Japan finally hiked its policy rate to 1.00% in June 2026, which, by the way, was their highest since 1995, the U.S. federal funds target was still sitting way up at 3.50%. Look, capital is smart. It naturally flows toward higher-paying dollar assets. Unless investors expect the yen to rapidly appreciate to somehow make up for that lost interest, they essentially have zero incentive to keep their money parked in Japan. Now, you might be asking yourself, well, why doesn't the Bank of Japan just hike rates to match the US? Well, they are facing a massive wall of complex headwinds. Japan has a staggering 1,344 trillion yen in public debt. That's hovering around 190% of their entire GDP. Plus, they're trying to unwind over a decade of ultra-easy money, all while dealing with an aging, shrinking population. If the central bank raises rates too fast, they risk rattling the Japanese government bond market, and that would instantly spike the refinancing costs for all that massive public debt. It's basically a macroeconomic high-wire act. Pulling one lever to fix the currency threatens to completely topple the debt market. Which brings us to Section 3, the carry trade danger and global market exposure. So what exactly is the carry trade? Well, for decades, Japan has effectively served as the world's primary cheap funding currency. Hedge funds, big institutions, and even some retail investors use this strategy. They borrow money in an environment where interest rates are dirt cheap, like Japan, and they use that borrowed money to buy assets in places where returns are much, much higher. Here are the actual mechanics of the trade. Step 1, you borrow yen at roughly 1%. Step 2, you convert those yen into US dollars. Step 3, you take those dollars and buy US tech stocks or maybe emerging market bonds yielding 4 to 8%. Step 4, you pocket the difference. Sounds great, right? But here is the massive danger. It's kind of like picking up pennies in front of a steamroller. If the Bank of Japan unexpectedly raises rates or the yen suddenly strengthens, the math completely implodes. Leveraged investors suddenly need more dollars just to pay back their original yen loans. This forces them to rapidly liquidate their global assets, stocks, crypto, bonds, the whole shebang, triggering a sudden sharp shock across global markets.
Let's move to Section 4, debunking the bailout myth and looking at the U.S. intervention facts.
Let's contextualize what actually happened when the U.S. Treasury, acting through the New York Fed, joined in by selling euros and buying yen to the tune of about $5 to $10 billion. Historically speaking, coordinated action like this is incredibly rare. The U.S. hasn't actually participated in coordinated yen buying since 1998 during the Asian financial crisis. They did intervene in 2011, sure, but that was to weaken a surging yen after the Tohoku disaster. So yes, for sure, this 2026 intervention was a very big deal. So the crucial point here is making the distinction between routine financial plumbing and an actual full-blown sovereign bailout. A true fiscal bailout, like the ones we saw in Europe during the 2010s, is taxpayer-funded. It transfers risk, and it happens when a country literally cannot pay its bills. Guys, Japan is absolutely not in that position. They have massive domestic savings and over $1.2 trillion in foreign reserves. What the U.S. provided was liquidity support. This is strictly about collateralized market plumbing to ensure global markets keep functioning without freezing up.
The U.S. actually has specific collateral-backed tools designed for this exact scenario. We were talking about the Fed's FEMA repo facility and standing dollar swap lines among major central banks. These are just liquidity backstops. They exist so that if Japan needs dollars to defend the yen, they can essentially borrow them against their U.S. Treasury holdings. The alternative? Japan hastily dumping billions of dollars in U.S. Treasuries onto the open market to raise cash. That would spike U.S. interest rates and directly hurt American consumers. So this cooperation is mutually beneficial plumbing, not some charity grant.
Finally, Section 5. 3 future scenarios and potential paths forward. Based on all this data, we can impartially map out 3 potential paths. Scenario 1 is a controlled adjustment. This is basically the base case policymakers are aiming for: gradual BOJ rate hikes, manageable bond yields, and no massive new energy shocks. The global impact, just a manageable drag on growth. Scenario 2 involves the international toolkit. If the yen slides again, we'd see more joint interventions and wider use of those dollar swap lines. It raises political tension, but it contains the stress. Then there's Scenario 3, the global financial shock. This requires a massive break in market functioning, like a sudden yen surge triggering a forced, leveraged carry trade unwind combined with a major policy mistake. It's really important to note here that a catastrophic global crash requires all of these sudden, uncoordinated shocks to hit the system simultaneously. Which brings us to a really perfect summary of this entire complex situation. To quote the source analysis directly, Japan is leaving a unique era of free money. The exit is underway, politically contested, and globally relevant. It deserves close attention. It does not yet deserve panic. The global economy is inextricably linked, and the yen's transition back to reality is definitely going to cause some ripples. But currency adjustments alone do not inherently equal a sovereign collapse. Ultimately, understanding the difference between a systemic crisis and routine market plumbing is the key to navigating our modern financial landscape. But it really begs the question, as the era of free money officially dies, are we just watching a temporary market correction, or are these the first tremors of a fundamentally shifting global order? Thank you so much for joining me for this explainer. For more, visit our website, Veris Solution.